Hi everyone. It's Thursday. It's around 2 o'clock. There's really not a whole lot going on today. S&P is rebounding some from yesterday's sharp decline. We're down about 90. We're up around 90 basis points. Um, I would say this is probably about the 50% retrace level. Actually, we're approaching the 61% retracement level. So we'll find out relatively soon. What's going to kind of start shaping up from here. I mean, when you look at the overall pattern, it kind of has like this rising wedge look to it. So that's something to keep in mind that maybe this is some sort of ending diagonal triangle or something. Certainly, you could make a case for it with this an A, a B, a C, a D, and then an E here. So we'll see. I mean, obviously today's OpEx, so there's lots of games that are played. And when you look at the sharp decline yesterday and you look at today's movement, it just, here's like an impulse down and here's like just kind of like a sideways consolidation, very similar to what we had been, really seeing, with the exception of, call it the pause in the tariffs. That was really sort of the exception there, but that's pretty much been, what we've been seeing now for some time: big declines, sideways consolidations, a little bit of a move up, then a come back down. So it's just more of the same, unfortunately. And that's not really bullish type of price action. When we look at the futures, just to kind of get a sense of volumes today, I mean, they're okay. They're decent. Today is an OpEx, so you would expect volumes to be higher just because. But it looks like we're on pace to probably do about the same as we did yesterday. I don't think it's going to be a meaningfully up day. So it's not really, it's really very quiet in my opinion. When you look at 10-year rates, those are up by 5 basis points today. The 30 years up 6. We are seeing the yen weakening a little bit. The yen's kind of just been really hugging this really important level here. I'd say this 142, 141 area. So really it becomes a question of, do we break this region? And if we break this region, do we move into the 130s? I think there's a good chance that might happen. We're just going to have to wait and find out. Again, largely we've been talking about capital flows out of dollar risk assets and into going back home, and that seems to be the case. I mean, I don't think anything has really changed there. When we look at things like the Japanese yen 5-year cross-currency swap, that's actually been moving back up again, and this could be an indication of two different things: liquidity is easing, and there's just more dollars available, or there's just no demand for dollars, and that's because currency is going home. So, I'm continuing to watch this to see if we can get any clues from it. Generally speaking, this has been a positive for stocks, but that was also generally at a time when we were seeing, foreign buying and foreign inflows. Now that's kind of changed because now we're clearly seeing foreign outflows, and so that's something to keep in mind. You're also seeing, credit spreads a little bit tighter today. Certainly nothing to really write home about. We are seeing SOFR swap spreads also moving down a little wider today. Sorry, a little narrower today, becoming more negative. So nothing really alarming here. Nothing really that you kind of look at and say, oh my goodness. 2-year inflation swaps up a little bit today. 1-year swaps also up just a little bit today. We had a hot Philly Fed prices paid index again. So, I mean, overall, when we look at the market, I don't really think anything has materially changed from what we've been looking at the last couple of days. I think we're moving closer to a period where we're going to get another major move in things like the dollar. Here you can see the euro also getting very close to breaking out a key area, and that's really reflected in the dollar index, which is testing this lower bound here. We're just barely up today at 27 basis points, so we're barely hanging on to this area. And once the dollar breaks at 99.5, you're talking about moving back down to 97. and that could lead to a significant move in the yen. So for right now, I think a lot of this, really what happens next, I think is going to largely depend upon what the next major move in the dollar is. And I mean, when you look at the dollar, it doesn't look strong, and it doesn't look like it wants to move higher. So, I mean, if we're in a position where we are going to continue to see the yen strengthening, we are going to continue to see the euro strengthening, the pound strengthening, which has also been really moving up, then we're talking about, a market that's likely going to see further declines in it. And I don't think that's really changed. But I think, again, what this kind of tells us and dictates to us right now is that foreign flows right now are really largely in charge. And we have to kind of be really mindful of how these foreign flows are impacting prices. And if the flows continue the way they have been continuing, then I would expect that we're going to see not only lower prices, but probably undercut this low at 48.50 or so on the S&P. Again, generally speaking, just to kind of take a quick look, we have seen that TGA rise to 600 billion. So today we're going to get the SOMA. So it's up by about 300 billion this week. That means that all said and being equal, we should see reserve balances down by about 300 billion. They should be somewhere around 3.1 to 3.2. I don't know what today's TGA numbers will look like, but I'd imagine they'd be a little bit higher, maybe another 50 or 60 billion. And so that would maybe mean that you had 350 billion or so come out of reserves. And so maybe you're closer to 3.1 trillion. Next week, we should probably see reverse repo facility move back up a little bit. Today, that hit 58.6 billion. So, and then lastly, I just wanted to mention, here's the Philly Fed chart that shows the prices paid indexes, all moving higher, and the dotted lines are CPI and PPI, and they're all, basically implying to me that there's a little bit of a lag. So I would think that you're going to see CPI and PPI start moving higher with these prices paid indexes. And finally, I just wanted to touch on, what's really been happening with earnings, and you can see the latest estimates as of the 16th are down to 263.05. So we're down about 4%, 5% from the peak, the summer of last year, which isn't huge. But, again, when you take a multiple of 23 and you reduce it to a multiple of about 21, there's a 7 or 8% decline, and then you have a 4% decline in earnings. And that's pretty much how you come up with that 13% decline in the S&P. And so, generally speaking, if the growth rate is going lower because the E is going lower, then you would expect the PE to go down, and so that means that the P has to come down. So again, the E being the earnings, the PE being the multiple, and PE and the multiple basically is a reflection of your growth rate. Right now you're trading at basically 2 times growth when you look at 2025 numbers, and so if the multiple is going to come down with the growth rate, then that would imply that the price of the index has to come down as well. So that's another big factor here as we move forward. And my guess is as we go into the quarter next week, when we really get into things, we're going to probably see these numbers continue to come down. Anyway, have a great rest of your week. Enjoy your 3-day weekend. Have a happy Easter for those that celebrate, and we'll see you on Monday. Bye.